Admission of a new partner by investment. Revaluation of asset approach. First of all, at the time of administration of a new partner, we need to revalue the existing assets and liability, and thus prepare the revaluation of assets. It is because certain assets value increase over time while others also decrease. The asset value may differ from the book value due to the fact that asset is not static. So when the partnership dissolves due to the admission of a new partner, the assets may be differ, or the book value of the asset may be differ from its fair value. Next, please. Revaluation. Revaluation means reassessing the value of something. In the event of a change to the original partnership of a business, such as reassessment is done. Only assets and liabilities of the firm are revalued, and a revaluation of account is often to determine profit-loss resulting from the exercise. Okay, so please take note that it is nominal account that is prepared in the event of admission, retirement, or death of a partner, and changes in profit-sharing ratio. Alternatively, it can be said that it is preferred at the time of reconstitution of a partnership. Assets are also originally recorded at its original price, but when certain events occurred, such as, next please, a new partner is admitted, or number 2, or a partner is leaving the firm, and last, if the parents change their profit or loss sharing ratios, then the asset will have to be revalued. It is important to note that revaluation is only done for assets and liabilities, whereas income and expenses generated from the core business operation are excluded. Next, please. Revalued asset approach. Under this alternative, asset book values are increased to their fair values, or also asset book values can be decreased. The old partners' capital accounts are increased for their respective shares of increase in the books of the asset. And lastly, the partnership's total resulting capital is now equal to the prior capital balance plus the amount of asset revaluation, and then also the partner's investment is added. So there are two rationales in doing such exercise. First, the true value of asset is being reflected correctly on the books. And second, this is to ensure that new partners do not share the profit and loss on revaluation, since the revaluation changes the value of the asset. By doing the revaluing asset approach, the new partners will not have the chance to share the profit and loss. And the most important is that the true value of asset is basically its fair value. The main point is just pretty much updating the value of your asset from the original price into a more recent price or even market price. So evaluating asset is important when it comes to partnership dissolution.
So, for example, C is admitted to AB partnership by investing 220,000 for 40% capital interest in the partnership. Now, the carrying amount of the partnership net identifiable assets before C's admission are as follows. So we have here the net identifiable assets, the book value, the assets and liabilities of the partnership before C's admission. We also have here the profit or loss sharing ratio of the old partners. So for A, 60%, and for B, 40%. So C is to invest 220,000 for 40% capital interest. So first we have to determine the proportion of the partnership book value or the agreed capital for C after his investment. So C's investment is 220,000 pesos. So if we take that into account and we add it to the original partner's capital, which is 300,000, that is 200,000 plus 100,000, the that is 520,000. Now the agreed capital for C is 40% of the total partnership's capital. So 40% of 520,000 is only 208,000. So as you can see, there is a difference of 12,000, which means that the investment of C is more than his proportion of the partnership book value. So generally, an excess of investment over the book value of interest acquired indicates that the partnership's prior net assets are undervalued, or that the partnership has some unrecorded goodwill. So this is where we have to do the revaluation. So assuming a recent appraisal on the land indicates that the land has a fair value of 230,000, the increase or decrease on the carrying amount of the partnership's net identifiable assets before cease admission are as follows. So we have determined that the fair value of the land is 230,000, which means the value of the land has increased by 30,000. Now we have to account for this revaluation. So since the value of the land has increased, this is we are revaluing our asset upwards. So first, the asset book values are increased to their fair values. So how do we record that? The journal entries would be to increase the land by 30,000 to its fair value, and then we have to also increase the old partner's capital in respective of their shares on the revaluation. So we have this is based on their profit and loss sharing ratio. So we have to divide that 30,000 increase based on their profit and loss sharing ratio and increase the capital of the old partners. So for A, that is 60%, 18,000, and then B, 12,000. So that is the journal entry to record the revaluation of the land. After such entry is recorded, we have now the adjusted capital of the old partners. So after their respective share in the revaluation, the adjusted capital for A is 218,000 and for B 112,000. After we're done with the revaluation of the assets, we can now record C's admission to the partnership by his investment. So that is debit cash 220,000 and then capital of C of 220,000. So after C's admission, the capital balance are as follows. So for A, the capital is 218,000, B is 112,000, and C 220,000. The total partnership capital after C's admission would be 550,000, and 40% of that would be C's capital, and that is 220,000.